Everyone says that they want to buy stocks when stocks are on sale, but practically everyone doesn't do it. Today, we're going to show you what a real opportunity looks like and the price I would pay for it. So what have I told you? That the greatest investing opportunities don't come from tips or headlines. They come from mispricing. Now, of course, it sounds intuitive. And we all say like, oh, I want to buy something worth $1, but for less than $1. But what makes it worth less than $1? That moment when a great business with strong fundamentals and a powerful story trades at a price that just doesn't make any sense. Well, what do? We see the stock fall and we think that's the market telling us that we're wrong. When in actuality, it's quite the opposite. In a few minutes, I'm going to walk you through one specific example of a stock that we believe could be currently mispriced and why we're excited about it. But more importantly, we're going to give you the tools and the principles so that the next time you see a setup like this, you can recognize it and do more research. Remember, just because a stock is down does not mean it's a value. The key is to see a stock going down or even going up and to understand the fundamentals and to determine the real value of the company. So real quick, if you guys remember back in 2022, Google, Meta, all these companies fell like crazy. Google fell to $83.45 in October of 2022. And here's why it happened. First was inflation. Prices were going like crazy, over 8% per year. So the Fed said, let's slow down here. And they started to raise interest rates to cool things down. This was the big fear the market had. If the Fed raised rates, it was going to make the stock market plummet. And in 2022, it started to. And it hurt big tech temporarily, like Google, because now those future profits that we were expecting don't look as strong when you can go invest and get 4 or 5% returns with no risk. Second, ad money started to slow just a smidge. Google makes all of its money from ads, especially on this very service you're watching right now, YouTube. But advertisers got scared of a possible recession, started to pull back ad spending. Some shifted to cheaper and flashier platforms like TikTok. Google's ad growth barely moved. Even if that was the exact right assessment, is that a permanent thing? Are we always worried about recession? No. 4 out of every 5 years, we're in a growing economy. We're not in a recession. So even if you see that temporary dip, it will eventually go right back up. And here's what matters. Google didn't break. The moat is still there. A moat just means that they have strong protection, like a brand, market share, tech, something that makes it hard for competitors to come in and steal their lunch. Google still dominates search. YouTube is still massive and still growing. Now listen to this. There are many things that can cause a stock's price to drop. Emotions, headlines, earnings, interest rates, TikTok trends, you name it. And we'll talk more about that in a bit when I show you a stock today that might just be as mispriced as Google was back then. So what do we value investors do? We don't panic. If the fundamentals are strong and the price is low, that's when the best deals show up. But guess what? The perception has to be bad for that to be the case. It isn't possible for a company's stock to fall, the perception be great and awesome, it's a great company by the masses, and the stock continue to fall. You've got to be able to sit there and see the stock go like this and the fundamentals not going down as much, staying the same or getting better. If we'd bought Google back then at 83, today the stock is worth over $190. Guys, the crowd is usually wrong. You've got to remember that. We believe in a principle-driven approach to investing. One of our core beliefs, in fact, our fourth tenet says it best, and this is a line taken from Warren Buffett, Munger, Ben Graham. In the short run, stock market's a voting machine. In the long run, it's a weighing machine. That means that when the stock is going up, it's because people love it. It's voting itself up. When it's going down, it's because people don't like it. But guess what? This stock market in the short run doesn't care about the fundamentals. It doesn't sit there and say, wait, how are the prices going? How are the fundamentals? Oh, we got to check this out. In the long run, though, the stock will go where the fundamentals go. Let me give you an example. Let's say you bought a stock today, and let's say it was making $10 per share and you paid $200 for it. So a 20 PE. And that was reasonable for that company. Let's say the stock market shut down tomorrow. So you still own that share of the company. And in the next 10 years, this company's profit went up from $10 a share to $50 per share. And all of a sudden the market opened. What do you think the stock would sell for? Well, at a 20 PE, it should sell for about $1,000. And that's probably true. It would go from 200 to probably 1,000. But guess what? Along the way, if the stock market would open, this would be the price movement. Or this, then this, and all these things would happen. We don't know where it would go. But the key to understand is if the stock's fundamentals are getting better and the price is lower and you can make a great return on that money, that's what we're looking for. Over time, the thing that matters is what's the business actually worth? And that's driven by the fundamentals. And there lies the problem. Most investors pay the wrong price. They chase the hot story. They chase the stock price going up. They fall in love with the hype. They have FOMO. They have fear of missing out, and they forget to ask the question that matters. What's the company worth? Guys, there are a lot of great companies out there. Pretty much every company we talk about on this channel is a great company in some fashion. But the fifth and most important tenet of our principle-driven investing is a great story or a great company can become a bad investment if you pay the wrong price. And Buffett always says it, speculation is most dangerous when it looks easiest. Everyone feels like a genius when stocks are going up, but that doesn't mean they understand what they own. The number of people out there who sit there and say to me, Paul, I love this company at 300. I'm a value investor. I want it at 250. Hello, it's not even worth 250. Just because you like it when a stock falls a little bit doesn't make you a value investor. I used to be like that. I used to see a stock at 300 and it went to 200. I was like, oh, it's a deal. It's less expensive, but it doesn't mean it's still not expensive. The example I give to that one is, let's say you own a home that's worth $400,000. And tomorrow you said, I'm going to ask $4 million. It sits there. It's overpriced. Okay, fine. I'll drop it in half to $2 million. Guess what? It's still overpriced. Not as overpriced as before, but it's still overpriced. And guys, if that can happen, in other times, the exact opposite can happen. A great company can get crushed. The stock can get crushed. Maybe earnings dip temporarily, or just the perception of it goes down. And suddenly the market acts like the company is going bankrupt. That's when fear takes over. But what we're here to do on this channel, whether you're a beginner or more advanced, is to talk about the fundamentals and say, guys, we want you to track the fundamentals and see when there's a disconnect between price and value. We want when price is lower than value. But again, the story is a component of everything, but it's not the only component. We care as much about the fundamentals as the story. And today, when I show you the stock that we're talking about, you'll be able to use this lesson. You'll start to recognize when price becomes disconnected from value. Now, unfortunately, we're not going to know the outcome of this for many years to come, but I encourage you, if you're new to our channel, to look at our videos from early 2021 when we were talking about EV cars, we were talking about cannabis, we were talking about Cathie Wood and ARK, and everyone thought we were crazy for saying these things were overpriced. And the vast majority went to zero or fell 80 or 90%. So, what is the stock we're looking at? You're probably wondering, Paul, what is it? Well, first off, I own it, and it's a company I've talked about several times in this channel, and it is Southwest Airlines. Southwest Airlines is an airline, and that's a tough business to be in, and that's one of my biggest concerns about the investment. However, up until COVID, it had never had a year of loss. In fact, even since COVID, if we look at our financials here, pulling up our software, if you look at the net income, they only had 1 year of loss, and that was the year of COVID, 2020. They've still been profitable since then. Now, before COVID, they were making 10 to 15% bottom line profit every year. Now what are they making? In the last 5 years, they've averaged a loss of 0.65%, and last year they made 2%, far below their average. But guess what? Their revenue is at a peak. They've had new people take over, and they're starting to change things within the company. I believe this is a reversion to the mean. They've had computer issues. They've had Boeing 737 issues. These are things that have cost them a lot of money. But guess what? I believe that this company that focuses on a one plane, that hedges their fuel so well, that has always been a great operator, did not just change overnight. I believe they're going to get back to their good ways. And guess what? I don't need to be right back to pre-COVID levels. If we're even back to 7, 8, 9% consistently, this company has amazing potential. Let's look at some of the data here. And these are the main data points we put here. Now, first off, if you're in our community, this is what I love. We have 15 community members who voted on Southwest, and the actual average rating is a hold rating. So if you're in our community, go in there and make sure you vote. I love the fact that everybody in the community, a lot of people still disagree with me. Guys, if you're new to investing, this may seem overwhelming, and I assure you that I'm going to explain this as simple as possible. And in fact, these key metrics are very important to understand, and I make it easy for you. If you want to get an absolutely free PDF explaining all of these metrics right here, so that while you listen to videos, you can look them up, or if you're just bored and saying, hey, listen, let me learn more about investing, this is a great place to start. So click the link below, input your email. Within a minute, you'll have a PDF absolutely free, no strings attached, sent to your email of all of the metrics here and the explanation of what they are and why they're important. This is and by the way, even if you're advanced and you just want more information on this, it's perfect for you as well. I still look at this PDF on a regular basis to remind myself of what matters. Now, market cap, 20 billion, enterprise value, a little bit higher, 35 billion. That means $15 billion in debt. Their cash flow has been struggling. But again, if you go back to pre-COVID levels, their COVID level cash flow was 3 billion, 3 billion, 1.7 billion, 2 billion, 1.1. So their cash flow has been suffering. But again, I believe this company will get back to normal because it was a well-run airline before. I don't think that's going to change. So let's go see what analysts think. Well, guys, here's what's interesting. Analysts expect $1.18 in profit this year, growing to $4.25 in the next 3 or 4 years. I do not believe analysts are the be-all and end-all. It's a great place to start because they do talk intimately with these companies. So they have some sort of inside information, not literally inside information, but they have more of what are they trying to do and what can they accomplish here. Does that mean they're right? Absolutely not. And they fall for the same gimmicks and FOMO that other people fall for. But again, it's a nice place to look to say, what are analysts saying here? Now, we have a story. We have a thesis. Now we have the numbers, and we can go sit there and put in our stock analyzer tool. This is what I meant earlier when I said, this is where we go to figure out what is the company worth. We're taking the story and we're making assumptions on revenue growth, profit margin, future PE, and then what we want to earn on that. And we plug it all in, low, middle, high assumptions, and it spits out a number for us. What we do with that number is we decide, are we buyers? Are we sellers? Or are we just waiting? That's the big key here. This is why this tool has been used over 1 million times per year by our users and growing. It is the best tool in our software, but one of 20 tools that people use and tons of content in our software to be able to use it. So let's go pull up my last time I did Southwest Airlines. So here are my revenue growth assumptions. I did 2, 4, and 6%. Now, profit margin and free cash flow. I did 8, 11, and 14. Keep in mind, guys, I did not go to the level. They did 10 to 15% before COVID. I made my highest level 14%. They could easily crush this. But let's say they don't do as well as they did before. PE. I think it's the best run airline. They have a return on capital of 8% over the last 10 years, with the last 5 years being negative. So their return on capital was well into the double digits, into the teens before COVID. Now you might be wondering, what does that mean? Well, great companies have high returns on capital. They're able to put money into their business and generate a lot of profit. Think about it this way. If you and I each had $1 million and we had a business we had to invest in, if I invested $1 million and made 10% of my money, and you invested $1 million and made 30% of your money, which one's better? If everything else was the same, which one's the better company? Of course, yours. Because you can invest $1 million and make 30%. I need $3 million to make that same amount of money. I invest $1 million, I make 100,000. You invest $1 million, you make 300,000. Yours is the better company. That's why we focus on this. And it's been temporarily hurt by their cash flow issues. But again, I think this is a longer term play that when it turns around will be a lot better. I'm doing 8, 11, and 14 for the PE. I'm doing 14, 17, and 20. And finally, my desired return of 9%. Now, guys, keep in mind, 9% is the market return. You need margin of safety. If you're going to just get the market return, go buy an ETF, which you probably do. So in order to really buy an individual stock, increase your return. Make it whatever number you want. If you feel comfortable with the investment, make it a lower number than 12 or 13. If you don't feel comfortable with it, higher, or just avoid it altogether. But the point is, this number here is basically say, this is what the company I think is worth based on these assumptions. So I hit the analyze button, boom. I have a low price of 52, high price of 152, middle price of 90. If my middle assumptions occur it's a 25% return on my money. Now, the big key here is, even if I'm not fully right on these, but it gets better than today, this company, I think, will make me money. That's the big key. It's all about finding that margin of safety where even if I'm wrong, I'm not going to be that hurt. Now, guys, there is another stock that we're starting to see some potential mispricing, and that stock has actually dropped 37% so far. So click at the video on your screen, and I'll walk you through why it looks interesting. Thank you for your time.